Hello students and welcome to the lecture. So students, as we know that we are covering the financial knowledge and the banking awareness part of it. Okay? And basically we are covering the banking history in it. In the previous lecture, we had done with the liberalization era. Okay? And also we have looked upon various concepts and even the current scenario, right? All these things we had covered. All right. So basically what we are going to do in this lecture, if we are covering the banking history. Okay. So basically we are going to cover on the banking history. What kind of these details are? So let me tell you one thing straightforward first. You will be only able to listen the lecture, or you can say to understand the lecture properly if you have revised previous one. If you have revised the previous lectures, then only you are able to understand this lecture. Okay. Second thing is that we are going to have quick overview on things we had covered in the previous lecture as a revision. And also we will discuss some facts and figures which we hadn't discussed in the previous lecture. So that's why I am telling you, if you have revised the previous lectures, then you will be only able to grasp the facts and figures I am going to tell you now. Alright? Because we are going to have a quick overview and a little bit revision in this lecture on the topics we had covered. Also, we will counter some new topics which we hadn't covered in the previous one. So now, it's upon your honesty. If you had revised the facts, then congratulations, you will be able to understand the facts. But if you haven't revised the facts, then there might be some trouble with you to understand this lecture. Okay. So with this note, let's start this lecture. So basically, in more details of banking history in India, first we have the pre-independence phase, start from 1770s to the 1947. Okay. So if we talk about this thing, then remember I had told you the concept of banking in India dates back to ancient times, as it mentioned in Vedas, Sutras and Jataks, okay, which is generally referred as a usury and credit instruments, like we had discussed the predatory loans, right? It means in the Vedas, we had a clear-cut mention that we were practicing the banking activities. There were many banking activities we were practicing on that time. Alright? But why we called 1770 as the main year for the origin of the banking in India? So basically, this is because the Bank of Hindustan, which was established in 1770, and it was the first institutional organization involved in the banking business. Alright, so remember this point we had already discussed. Now come to the modern period. The practice of Adesh or the bills of exchange was in use, and loan deeds called Dastavej were prevalent during the Mughal era. Now if we talk about the bills of exchange, about which we had already discussed in the previous lecture, it's basically a part of negotiable instrument which involves three parties: payer, pay, beneficiary. Payer, pay and the beneficiary. Okay. So basically the payer is the one who purchased the item. Alright. Beneficiary is the one who sold the item. Okay. And pay maybe the bank or any financial institution. Now, how the BOE or the bills of exchange work? So basically, bills of exchange are divided into two main bills. First is bill payable, and second one is bill receivable. Okay, so there are two types of bills. So the payer, who is the person who bought something. Suppose he bought an item for 50,000. Okay, but he did not have 50,000 on that time when he purchased the item. So he asked the beneficiary that he will pay this 50,000 after 10 days of purchase. Okay, the beneficiary or the seller agrees, okay, you can pay me on that time. So what he will do, he will make a bill which is known as the bills payable. Okay, this bill will contain the amount 50,000. Alright, and this bill will hand it over to the beneficiary. Okay, thereafter, the beneficiary is responsible to present the bill to the bank on which the bill has been drawn. Suppose the payer having the bank account in XYZ. Okay, so the beneficiary will present the bill to the XYZ bank. Okay, and then bank will pay the money to him on behalf of the payer. Okay, and thereafter the 50,000 will be deducted from the account of payer. Okay, let me compile it in a short so that you can understand it properly, because I think that maybe you haven't revised it. Payer is the person who purchased the item, then he makes the bill on certain banks like XYZ. The bill will handed over to the seller and the beneficiary who sold the item. The bill received by him is known as the bills receivable. Thereafter, after the time period, means the 10 days, 15 days, whatever the time period, the beneficiary will present the bill to the bank account. The bank account will pay the bill to the beneficiary on behalf of the payer, and then the amount which has been paid to the beneficiary will be deducted from the account of the payer. That's how the system works. Okay, so this is the bills payable, and the bills receivable is basically holded over by the beneficiary or the person who holds the bill. Okay, so this is called the Adesh. And remember one thing, in modern terms, BOE is transferable. Okay, this could be transferred from one person to another, like A, B, and C. There are three persons. B is the seller, A is the buyer. So in that case, A will be the payer, B will be the beneficiary. Okay, but suppose if total amount which is to be paid to B was rupees 10,000. Okay, rupees 10,000, and this amount is basically on B from C, which means the B is required to pay 10,000 to C for some reason. Okay, so in that case, B can ask A to transfer the bill to C. Okay, otherwise the bill is required to be made on the name of B because A has purchased the item from B. But because the B has purchased some item from C and he is liable to pay him the amount, so the B could ask him, do not give me the money, transfer the bill to C. Okay, so his payment could be set off. This is called the transferable, you can say transferable provision of the bills of payment or bills of exchange. Okay. And the person who presents the bill before bank is the person who received the money. Okay. So basically the person who will present the bill in front of the bank is the person who will receive the money from the bank. Like in this case, A made the bill, B was the receiver. Okay. But because the bill transferred to the C, then the bill will present to the bank by the C, and then C will get the amount. Okay. So this is the bills of exchange provision. And remember, it is controlled by Negotiable Instrument Act 1881. Okay. So in the time period of Mauryans, basically the state has the responsibility to pay the bills, and that's why they are known as the pay. Okay. Now come to the Dastavej. So Dastavej were basically the loan deeds. Alright. And you can say they are basically the loan agreements. Got it? Now let's move forward. The evolution of hundis, a type of credit instrument, also occurred during this period and continues to be used. Okay. So what were the hundis? So hundis were basically also the type of bills of exchange. Why? Because it is the written promise made by one person to another person, or making payment of some amount after some time. Okay. So that's why they are also considered as a type of bills of exchange. Now, early banking in India, pre-19th century. Before the 19th century, banking in India was largely unorganized and decentralized. It was primarily dominated by the indigenous bankers and the money lenders. Because remember when I had told you, when the Britishers introduced their monetary economy, because prior to them we were focusing on the barter system, right? Even the Indian rulers were practicing the barter system. So when the Britishers pushed the monetary economy on the residents of Indians, okay, so there was a need of the banking, because the people generally did not have the cash or cash flow. Okay, it means that they had to borrow it from someone, and whenever they going to borrow, so they were basically borrowing it from the money lenders and the indigenous bankers, which are often on predatory loan terms. Okay, like as we had discussed, if the rupees 10 has been taken as a loan, then 35% is the interest on it, and the amount is required to pay it within 2 months. So it means 10 into 35 into 2 divided by 100. Okay, 7 is the interest to be charged on. Alright, so 17 rupees the person is required to pay it off. Okay, just think, the person who is just earning 10 or lowest than this amount, he is not even earning the 10 rupees. That's why he has to borrow it. So the person who is not able to have the 10 rupees, how he will be able to pay 17 rupees just after the 2 months? Because the interest rate was so high, and even their properties were attached by the moneylenders and the indigenous bankers when they granted the loans. And if the person defaults to pay them back, then they generally acquired their properties, exploit them, their other means, and many other cruel things they could do. Okay, so that's why predatory loans were, you can say, damaging the economy prior to the 19th century. Okay. The East India Company and a few European banks, such as the Bank of Hindustan and Central Bank of India, played a limited role in facilitating trade and finance. Like, as I had told you, the Britishers, who were basically focusing on enhancing state revenue or the government revenue. Okay, so just tell me one thing. The major chunk of government revenue is come from the taxes charged by people on various things, right? Even if we talk about today, then about 1.3 trillions is just collected through the goods and services tax known as the GST. Okay, so now you can understand what I'm trying to say. Because the Britishers were focusing on enhancing the state revenue, and the major chunk of the state revenue comes from the taxes imposed on the public on various things. So that's why tax collection was very, very essential for the Britishers. All right. Okay. So that's why the Britishers started focusing on their tax revenue. Prior to them, the Indian rulers were collecting taxes in form of in form of produce. But they introduced the monty system. Okay, so the taxpayers or the resident of Indians who were largely depends upon the indigenous bankers and the money lenders to borrow the money and to pay the taxes and spend their money, and the loan which granted to them basically based on the predatory loans terms. That's why there was a huge suffering and the taxpayers were not able to pay the taxes. And the major chunk of the British government was, British revenue was deteriorating. So to handle the situation, the Britishers started focusing on facilitation to the taxpayers and providing them loans and monies and other things. East India Company by itself, along with the Bank of Hindustan and the General Bank of India, started facilitating them. But the need was too huge that even the Bank of Hindustan and General Bank of India collapsed, or you can say liquidated after some time, because they do not have sufficient capital to run off. Either the public was not depositing their money, or the people who took the loan from them not repaying it back. That's why many of the banks got failed. Okay, now come to the banking in British India, 19th century to the early 20th century. The early 19th century saw the establishment of several European banks like Bank of Bengal, Bank of Bombay, and Bank of Madras, later merged to form the Imperial Bank of India in 1921. Okay, so because of the collapse of the British banks and various other methods acquired by the British government to enhance the state revenue, which could only be earned through the taxes, and taxes could only be earned if the income of residents increasing. right? That was the scenario. So that's why the British government thought of to establish their own banks, and that's how the Bank of Bengal, which was established in 1806, just correct it. Okay, it was the first bank. Then the Bank of Bombay, established in 1840. Then the Bank of Madras, 1843. They all were established as presidencies banks, right? And even their resources got consolidated as a Presidencies Bank Act, 1876, for their better operational qualities. Okay, but somehow even when we entered into the 20th century, other European powers who were trying to attract the Indian consumers, who were trying to interfere in the Indian banking economy, and even the World War I had impacted the British government a lot. That's why that was the year of 1921 when finally resources of Bank of Bengal plus Bank of Bombay plus Bank of Madras got what? Got consolidated. And remember, I had told you, whenever two or more entities consolidated together, then basically new entity formed. Okay, so in the year of 1921, when all the three presidencies bank got consolidated, then finally we had the Imperial Bank of India as a new entity after the consolidation in year of 1921. Remember these details. These banks were under the control of the British government because they were established by the Britishers. Primary function was to finance trade and government transactions. Okay, so that they could enhance the income of residents and could impose more taxes on them to eventually leads to increasing British revenue. Okay, that was their idea. Indigenous and regional banks continued to operate alongside the European banks, serving local businesses and the communities. You know, the Britishers who were establishing the banks, actually they only wanted the banks to facilitate their own interest. They wanted to raise the income of the residents, not because they care for the resident, because they wanted to increase the tax slab so that they could earn more and more. They facilitate the trade, but the trade which is only in favor of Britishers. If the trade is not in the favor of Britishers, you won't get any support from the British banks. Okay, government transactions are only for the benefits of the Britishers. That's why the Indians who wanted to do something for Indians and to do the real welfare of the Indians, they started opening their own banks. Like we had discussed as a Punjab National Bank. Okay. Central Bank of India, okay, like the Bank of Baroda. So various banks were opened by the Indians to support the local businesses and the communities. Okay. So students, basically in this lecture, we had covered the several facts and figures, and basically we have done a little bit revision of the things which we had covered in the previous lecture. I hope that you have revised something which you haven't before starting of the lecture, and even you are going to learn something new. Okay. So basically in the next lecture, we will continue with the same thing. Okay. With the same topic. Till then, just please revise the facts and figures we have discussed in this lecture and prepare yourself for the next lecture. As I have told you, it is for your own benefit. If you revise on the continuous basis, it means that the things are not piling up and you will have a better edge on the topics because you are revising them on a continuous basis. If you are not doing this thing, then you won't be able to grasp the facts and figures properly in a proper manner. Okay. And when we will doing the examples and solutions, during that time, you will suffer a lot. Okay. So that's why it's my request to you, please revise the facts and figures on the regular basis. It's for your own benefit. Okay. So with this note, let's finally end this session and thank you.